All right, what is going on, Discord family, and welcome back to another edition of Market Review with me, t.hobbs. As you guys know, I don't do market reviews on Friday, but I do review the market from Friday. I just do it on Saturday. So today's market review will be on January 11th is the film date, but we're reviewing price action from January 10th, Friday. We'll be reviewing the NASDAQ E-mini chart, Dow Jones, and the S&P, all E-mini charts. All right. So the first thing I like to do is take a look at the pre-market plan as per usual, and then kind of go deep dive into like what I was seeing, how the market reacted to our plan, all that good stuff. All right. So our pre-market plan for the NASDAQ, for the YM, I only wrote one plan, right? I only write one plan unless it's, by request. Like somebody's asking me, hey, can you write a plan for the NASDAQ or the S&P 500? Other than that, I only write one plan. All right. So current conditions, markdown phase, meaning there's, three phases in the market, right? Like you got your markdown, markup, and then you got your consolidation, right? Or accumulation phase. Then, you could add more phases, reaccumulation. Anyway, but we are currently in the markdown phase because, if you look at the daily chart, we're in a very, very strong downtrend. So inside of this dealing range, we're bullish as long as we stayed above 601, right? Which was, I believe, down here. Yeah, at the low of the range at 601. And we were bearish as long as we stayed above 42,924. Below 42,924, which was the weekly fib and previous day high from Wednesday. We absolutely accomplished that. And every time we came up to this weekly fib, the sellers continued to defend, which made me very, very bearish on the day. Okay. Macro, the bears are continuing to defend the weekly fib, but we look prime for a reversal here. So this area here, right, in my initial analysis, I thought, well, this is November 4th low, right? We've tapped into it 3 times. I was kind of looking at this inverse head and shoulders potential, right? To take out these highs. Turns out there was no reversal in this area, right? So my original thesis of bearish and markdown phase was correct, right? But as you can see, we have been in balance range for 2.5 days. If the downtrend is to be respected, bears must win this consolidation battle by breaking down and targeting 42,276, which is ultimately what they ended up doing. Remember, I write these plans at like 6:30, 7:30 a.m. Market time. So like by the time I write my plan, none of this has happened already, right? So NFP should make the final decision, which it did. Above weekly fib, I am looking for longs targeting 43,213. And that's what this sentence was about, right? Look for a prime reversal. But to me, if we were gonna reverse, it had to be a break above weekly fib, and we just never got it, right? Therefore, I was looking for shorts coming back down. My pre-market plan specifically was, if we came up to this MWOG, I was looking to short week rallies into 43,024 through 43,000, and then target the low of the range, and then finally 4-hour demand. Essentially, if the NFP candle went up first, I was looking to short it, right, from this level. If it went down first, then I thought it would be a good long into this level, which was my other pre-market plan. Look for buyers to defend 4-hour demand at 519 through 42,276. We can look to long the market targeting just the low of the range. So this lower white box right here. To the downside even further, I was looking for a break and retest below 276 and look to target the 4-hour support first at 41,981. We didn't quite get down there. We got to 42,084, right? And then the 4-hour demand down here never really got triggered, but I'm anticipating that being triggered on Monday or Tuesday, right? If we continue to the downside. Our range in the middle, which is probably the most important part, right? Like it's always the meat and potatoes right here. The high was 42,980 through 42,848, basically this entire high right here, right? And then the low was 42,767 through 42,653. I think I kept moving this up or down, or I didn't really adjust this range because the range seems to be off a little bit, but you get the point. 42,719 through roughly about 42,606 was the range. Anything in the white box down here or anything in the white box up here, I was looking to short, right? And now let's talk about kind of how price was delivered on the day, right? So let's go into the object tree, take off the pre-market plan here. Here we go. Let's drop down to the 15-minute, right? And I'll kind of show you guys kind of what my thoughts were on the day, right? Before price came down. When price was up here, if we look back, right, we were in a balanced range, right? Now, you have to understand that inside of a bearish trend, first of all, we've been in a bullish trend for basically since 2020, but 2023 October is what started this ridiculous rally. So everybody and their mother, including me, because I'm human, right? We have recency bias. When we see this consolidation at the potential low of a trend, we automatically think that the bulls are about to, run it back up. But that's not what's happening right now. What's happening now is the sentiment is shifting, meaning the market is starting to consolidate at lows and then being okay with dumping lower, which is a sign that the market has turned very, very bearish. The Dow Jones, for perspective's sake, is down over 7.5% from its all-time highs. At 10%, I mean, we're officially in a pullback territory. If we continue down where I think we're going to go, I think we're going to be in correction and even close to a bear market below 20% correction, right? But that being said, as I'm seeing this price action from Wednesday, this level here was very, very key. Notice the weekly fib, right? This means that this is the 50% of last week's price action here, and we are not getting back above it. As a fair value level, which is the weekly fib, if we can't trade back above it, that means that the market is trying to trade away from it to the downside. It was prevalent here on Wednesday at 2:15. It was prevalent here on Thursday at 05, right? And it was prevalent here the morning of Friday at 6 a.m. Whenever the market fails 3 to 4 times at the same level, it's not trying to trade higher, right? And then the resulting factor was the news candle at 8:30 dropped down. When I saw this news candle drop down here, and anybody that was trading live with us, you know that I took a fib, right? Basically from this low, right? From the open candle all the way down to the wick, right? Now, one thing you could do that's a little bit more accurate, right, is go down to the 5-minute, because the 5-minute time frame is kind of like the king time frame. I don't know why. It's like the sweet spot, right? When you're trading on lower time frames, 5-minute is like the sweet spot. 15-minute is more like your guide, like the hour or the 4-hour, right? But the 5-minute is like that sweet spot between the 1 and the 15. So if you take the opening candle, right, all the way to the close, right, and you just fib that out, you come up with a nice area to trade the market in for those NFP candles. Now, does this work every single time? No, because the delivery is different. But based off the delivery that we were getting, this area was very key. And I called this level out live. I said, hey, 640. I had 644 because I took it from the 15-minute. However, if you look at the pre-market plan, our idea is always, if we break through the bottom of the range, right, aggressively and close below, I'm looking for a break and a retest of the low of the range to continue down further. Essentially, that's exactly what we got inside of this area. We dropped down into the demand zone, which I should have took longs right here, right, targeting this high right here. But instead, I waited for price to come down here, right, and I took longs off 546. I added to the position at 522, and then we were targeting the highs right up in here. We came right up in here, got out of the trade for a quick scalp, and then we ended up catching the big move to the downside, which we'll talk about here in a second. But if we go down to the 5-minute, to the 1-minute, and then we bring in time and see how time flows with the equation, right? Like, everything comes together at a certain time, right? Whether you believe it or not, it's true, right? I don't really care for, arguing or discussing it. It's true, right? Time and market structure rules the market. That's it, right? So if you come up here, right, and you look at 929.30, right? All I wanted to see inside of the Dow Jones is I wanted to see us trade down into 930, and I immediately wanted to get long, right? But I knew we were in bearish character, so I only wanted to target these highs right here. We took longs. Like I said, I put a limit order at 546. The limit order was in drawdown. I re-added to the position at 522. The market pushed up. I took off 2 contracts up at the high, and then I moved my stop up to 610 or whatever the bottom of this range was, and I got stopped out here in profit. When the market came back down, this was a dilemma. Not necessarily a dilemma, but this is something that I've struggled with in the past, right? I want to share this with you guys because some of you guys, I heard you trading live, and some of you guys also were struggling with this. That dilemma is that we are supply and demand traders, most of us, right? A good majority of us in here trade supply and demand, support and resistant, right? So everybody and their mother had this 4-hour or a daily demand or whatever it was on your chart. I know because I heard everybody say, well, we're in demand, so I want to try to get long. You have to be able to adjust to what the market has delivered thus far, right? One thing that I've struggled with is saying, well, I'm not going to get, and you guys heard me say it during the live stream. I said, I don't want to get short inside of demand. It'll break too many rules. And then I started looking at the volatility index. I started looking at the market. And then I started to think about things that I've struggled with in the past, which was going against the structure to facilitate the demand zone, right? The demand zone is nothing but liquidity. That's it. If it's time for it to be taken out, that's a good trade that you can take no matter what, right? This candle here, along with this consolidation, along with the strength of the VIX, was enough to convince me to take the trade short inside of demand and break that particular rule. This was not a trade that I had planned in my pre-market plan. This was a trade that developed as I was watching it, right? So as the market was breaking down, we broke structure. I essentially just looked for this little gap right here. And I said, hey, if the market comes back up here, I'm going to short, right? I got short at a 534 candle. I got short on this candle here. So I got short at 42,534. Rolled the market down. You know, we set through a lot of, it was just back and forth, back and forth, back and forth. But it didn't matter, right? Because guys, my P&L was fluctuating on two contracts between $1,000 and negative $100. And it was doing it in a matter of minutes, right? Like just really fast. And as quote unquote spooky as it was, you have to remember that every risk is the same and it's all defined by the user, right? I am the trader. I control my risk, not the market. Do not let the market scare you out of your position. This was my risk right here, right? My risk was 68 points. I said, my thought process was, if the market gets back above this high, I'll look to either reposition myself or give up on the trade. As long as we stayed below this high at 678, I thought that it was still valid shorts. So the market could have ran my stop and came right back into this area. And guess what? I would have got stopped out, but I still would have been interested in the short, because that's the process in which that's the market structure that was telling me, hey, this was a good trade. But my risk was 73 points to make 320 points, 326 points, right? My overall target obviously didn't get hit, but we were looking for 550 points. In the game of risk versus reward, you have to be willing to risk in order to get rewarded. If you miss every single opportunity that comes your way, you'll only find yourself chasing bad opportunities, right? Making up plans that don't make sense, right? Instead of just sticking to the plan that you originally had, right? This was my original plan, to long the market here and short the market here. Because I was in the longs, I didn't participate in the shorts up here. But my thought process was, well, if I was willing to get short up here and I was targeting 276, why wouldn't I entertain shorts here targeting the same level? It doesn't make any sense to pass on a 300-point trade. So yeah, I took the trade, right? Ultimately, what I'm trying to facilitate to you guys is, don't worry about things that you cannot control. Once the trade is on, I can't control what happens. The only thing I can control is how much I'm going to lose, right? And if you truly believe that, ignore the noise, right? The market is going to make a lot of noise. That's what it's designed to do. It's designed to fuck with your emotions. The faster these candles move in real time, the more your emotions are going to get routed. When we're looking at them in a still frame, you're like, yeah, of course you took that trade. That was a beautiful trade. But in real time, right? If you're not practicing real time forward testing and aggressive movements, paper trading, you know, looking at the market 24/7, when the market comes in with this aggressive volatility, right? You're gonna ignore it. You're not gonna want to trade because you're gonna be so frightened by the speed of the market instead of being focused on your process. I'm very focused on my process this year, no matter if the market's moving at a snail pace, no matter if it's moving at warp speed. I'm gonna do the same thing no matter what. This was a milestone for me, and I just wanted to share that with you guys, right? It wasn't monetary, it was psychological, okay? But anyway, we traded up into 950, put in a lower high inside of 950 and traded straight down to the lows right here. Hold on a second.
Wake up and bake up this shit, jump out the crib, stack up my C-No this shit, killing my ego this shit.
There we go. All right. Had to change the music. But okay, so then we traded up into 1025. Again, this is a macro that I made up myself, right? 1025 to 1045. I've just noticed a pattern inside of YM, right? And I always look for that 1037 candle, right? Like 1037 is usually super sauce. You can see right here at 1037, the market really never came back above that level until the PM session. If you trade YM with me, you know about this 1037 candle, right? Trading down all the way down until we reach about 11:50, 12 o'clock. Now, when I got done trading, I was done trading at like 10 Eastern, right? And I said, hey, do not try to short this market. It wasn't, long this market. I said, be careful trying to long this market. As the market's coming down, what do most people want to do? They don't want to participate in the shorts because most people say the same thing that I used to say myself, which I just kind of taken out of my vocabulary. Sorry, let me straighten this up. I've taken it completely out of my vocabulary because it just doesn't make sense, right? And that word is, or that phrase is, I don't want to short because the market is down too low, right? If the market is down too low, but it's aggressively selling off, fine, don't short it, right? I'm not saying get into the shorts, but here's what I will say. You need to understand that every single long opportunity you take is just a scalp to facilitate down until the market flips and makes a new high, right? The market did not flip here, right? If people were trying to get long here, that's fine, but you need to be out somewhere above this candle, right? The reason why this is not a flip is because the validated high is way up here. So this push back into this candle, this imbalance, is simply just to go lower if it doesn't take out this high. The market comes down and breaks this low. Now this is the new high, right? If that's the new high, the market still does not flip above that high. Then the market comes down and makes a new low, which makes this the new high. The rally pushes up, but still doesn't take out these highs. So again, the market trades down further, right? Taking out a new low. And then finally you get the flip. This is when the longs are valid, right? Once the market takes out 42,239, that means that everything above this level should be a buy, right? Now you can take longs anticipating this if you understand the shift, right? The shift is basically, it started here, right? When the market took out this particular high, but didn't take out the swing high. Usually I count about 3, maybe 4 swings, 1, 2, 3, 4, before the market starts to take off. When the market goes up and above this high again, it's a warning shot to me, mixed with time that we're about to go long. So I'm entering this trade right here at 1210, based anticipating the market taking out these, all 3 of these highs, right? Coming back into the center of what used to be demand, right? Market comes back up here, and let's say you missed this move and you're like, oh man, I missed the long. That's okay. Because if you understand structure, you know the market's going to double bottom before reversing at all. So if you anticipate that, guess what? This creates a short opportunity inside of 110, 140 macro back down to these lows. Or if you just want to stay on the long side of price, you're just going to have to wait a while, maybe like 410. If you're in Top Step, you wouldn't even be able to take this trade. You're going to have to wait a while because the market needs to come back down and either double bottom, put in a higher low, or sweep these lows before heading higher. The market does this every single time it's going to reverse. It does it, and whether you believe me or not, I'm telling you it happens because I back tested over 1,000 days of data, right? Like I've done years, not years of my life, but years of studying reversals in this market. And I'm telling you, no matter how much you think, you see something, or whatever, the market ain't gonna flip until it flips, right? So if you understand that, just be patient and either wait for the flip, continue to short it, right? Or do nothing, right, until it flips, or anticipate the flip. You could just do nothing, sit on your hands and say, okay, now I know the flip has happened, but I know it's gonna liquidate these lows and come back. So either participate in the shorts and take it back down, or just do nothing and just wait. Otherwise, stop getting in the way of aggressive buy days or aggressive sell days. You're only going to blow your account, piss yourself off, and make you feel like you can't trade at all. You know why I know that? It's because I've done it. I've been there, right? And I'm still fighting with those emotions of doing stupid shit when I know what the truth is. right? The market has a way of making you feel like what you're doing is the right thing at the right time because you're chasing some aggressive buying or selling that's coming into the market. You're just wrong, right? And it's okay to be wrong, but it's not okay to stay wrong, right? We'll briefly go over the S&P 500. As you can see, the market again respected the chessboard here at 610, came up to about, within 5 points of the top of the chessboard, 59.59. I believe Jay Seals, I read his plan this morning. He was looking for shorts as long as we stay below 59.17. You can see the high of this candle at 9:35 was 59.17. So he was first targeting 58.88 and then later 58.31. I left, so I'm not sure if he got involved with this trade, but 58.49.75 on the daily demand. This is very important, right? I talked about this level before I left. I said this is November 4th candle. The last time every instrument's come down here, well, YM's the only one that's been down here, but every time we've come down into these major lows, it causes a massive reaction. So you could look to get long, but just wait till we come down to 58.49. And you can see when we got back down to 58.49, the market reacted very aggressively off this level. And this is the level that caused the flip. This is a 61, almost a 62 point move on the S&P 500. This daily demand pushed the market up 1% in a matter of like 2 hours. Well, no, what is this? From 12, 2 hours. It rallied the market up 1%. That right there is easy money. Easy money. That's like a $6,000 trade on 2 minis on the S&P 500, right? But ultimately what I wanted to show you guys was the pre-market plan that I would have drawn out if I was still making pre-market plans for the S&P is a break and a retest of the chessboard. We push up here. Like Jay Seals said, he had a great plan, 59.17. Probably would have been my entry because I like entering on that right shoulder. Straight down to 58.49.75. I probably would have got out somewhere down here, trailing my stop really tightly. And then looking for longs if I was still in the market off 58.49.75. Once we got this little first tap right here, liquidation of these lows, I'm looking for longs targeting these highs right here. Easy money, man. Like you just gotta train, and eventually it's gonna click. Just whatever you do, don't quit, right? Whatever you do, do not quit. And briefly going over the NASDAQ, again, off the 5 minute, you take that, and I forgot to show you guys over on the S&P 500, but the fib from the top of the wick to the close of the candle here, look at that, 21,193.75. Perfect tap into that level, straight down, breaking these lows, tapping these lows, getting above the high. This is the flip you want to see on the NASDAQ. And then boom, here's your double bottom right there at 1205, straight long right off the top, targeting these highs right here. Easy money, man. All you got to do is practice it and be patient enough to wait till you see it. And it's okay to miss trades as you're developing, right? And understanding like what's happening. I just wanted to show you guys this quick fib on the S&P 500 from the top of the candle down to the base of the candle. Look at that, 59.20, right? All you got to do is start practicing and going back and studying NFP, studying CPI. Next week we got CPI and PPI and all that stuff. Go back and just Google the dates that these things happen and then just go study them. So when those days come up, you're not stuck like a deer in the headlights, right? Not knowing what to do because the market's moving too fast or the market's moving too slow, or I don't like the price action, or I don't like this. Stop telling yourself that, because it's not going to be any different. The market is never going to be, perfect per se. We are in an imperfect market, but the thing that can be better is your preparation, right? If you prepare, right, for this market, you will not be afraid of it when the market's on and popping. That being said, this is the market review. My name is T. Hobbs, and I'll catch you guys in the next one, man. Peace.